A joint venture is a business arrangement where two or more parties agree to pool resources to accomplish a specific task. At its core, it is a strategic partnership designed for a limited scope or a defined period of time. You need at least two distinct organizations to combine their strengths to reach a goal that neither could easily achieve alone. These ventures involve shared risk and reward, with every member having a say in how the project is managed. Unlike a merger, which creates one permanent company, a joint venture is usually built for a specific goal and timeline. Companies often contribute different strengths, like one bringing the cash while the other brings the technical expertise. The primary benefit is risk mitigation, as partners share both the costs of entry and the potential downsides of a project. Understanding how these structures work is key to evaluating business growth strategies. Thanks for watching and stay curious.